Hi, guys, welcome to Business Snap YouTube channel. Here I can provide you finance, investing and business updates. Before I start, please like and subscribe my YouTube channel.
Let's talk about 7 super safe dividend stock performers to buy 2021. Well, long-shot market bets don't usually work out in most cases. However, the brave contrarians who bought publicly traded securities in the initial outbreak of the coronavirus pandemic were able to make incredible profits. Many others quickly followed their lead and bought super safe dividend stocks. The June jobs report's strong showing has made it difficult to be defensive. Boring dividend stocks didn't have an incentive to grow in the 2020 rush, so you wouldn't be surprised to see them gain one now. This report showed evidence of a significant recovery with 850,000 employees added by employers in the first month. You shouldn't discount the possibility of dividend stocks, based on the positive jobs report. One thing is that the labor force participation rate remained unchanged at 61.6% between May and June. This is a strange result, indicating that millions of people who left the workforce because of COVID-19 are still in work. A single monthly reading is not enough to make any assumptions. Important to remember that the underlying economy and the equities markets are not the same thing. Although one concept can have an effect on the other, each component can be operated independently. This creates a risky situation as many securities are being stretched by over-speculation. Trustworthy dividend stocks are more appealing than fast-charging growth companies. Dividend stocks also offer 2 avenues to profitability. If shares go up in value, you can sell them and get the profits. You can also wait for a storm to pass while still earning passive income. These investments are relatively safe and should be considered by investors. Before we proceed, let me clarify one thing. This is not about converting all of your investments to dividend stocks. These are simply ideas that you can consider as the market's risk profile increases. Number 1. Safe dividend stocks as Costco, also called Cost. Costco stocks can be found at amazing volumes and you can find almost anything you need. However, you won't get a generous payout with Cost stock. Costco's last 12-month yield was only 0.71%. This isn't the equivalent of an 800-pound jar mayonnaise. If you are looking for safe and reliable shares, there won't be many that offer a better view. For one thing, Cost has provided 16 consecutive years of dividend increases. While this is a few years shy of aristocrat status, it's getting up there. Costco is a highly attractive business in these uncertain times. Of course, during the initial onslaught of the coronavirus pandemic, Costco was the place to go for a 5-year supply of rice, beans and toilet paper. The situation is much more stable today. The Black Friday Daily Catalyst has been removed, but Costco still benefits from a large membership base. According to multiple sources, Costco members have an average household income of $100,000. This is one dividend stock that will keep the lights on in case things go wrong. Number 2. Apple, also called AAPL. Apple's ability in a highly competitive market for smart devices has been questioned for a long time. Although the iPhone is iconic and well-known, I thought that Apple's brand would lose some of its intensity as there are many other devices with similar technology at a lower cost. But, I was wrong to doubt AAPL stock. It keeps charging higher. Apple might not be a good investment if you are at least slightly concerned about the economic health. If a company makes premium consumer electronics, why bother when a lower-end device can do the same thing? Consumers are happy to pay whatever it takes to get the latest iPhone or whatever. You really can't put a price tag on that kind of organic enthusiasm. It's not the most generous dividend stock, but it isn't the least pleasant. This is due to Apple's strong business. The last 12-month yield of 0.63% was incredibly low. This discretionary name is still one you can rely on, even if you look at it from the positive side. Number 3. Safe dividend stocks as Abbott Laboratories, called Abbtt. Analysts have always considered Abbott Laboratories to be one of the safest dividend stocks to invest in. Abbott Laboratories is a multinational healthcare and medical device company that specializes in testing platforms. It has been relevant for many years, but it lacks excitement. Fortunately, all that changed with the coronavirus outbreak. Investors couldn't stop buying Abbott stock. Yes, the focus was on the development of vaccines and antibody treatments. These avenues would likely leave few winners. Instead, Abbott was naturally positioned to play a higher probability game: affordable and easily accessible COVID-19 testing kit. This naturally led to Abbott being a dividend stock that earned both passive income as well as capital gains. Moving forward, I like the relevance of its business, especially regarding Freestyle Libre, which is its continuous glucose monitoring solution to diabetes patients. Freestyle does not require fingerstick calibrations, as I wrote about Senseonics. Even with the strong competition, Abbott is a viable option. Number 4. Procter Gamble, called PG. When asked about safe dividend stocks, my mind immediately goes to Procter & Gamble. How can it not? It's just one knee-jerk reaction that you can give with 100% upside and zero controversy. PG stock is the equivalent of your three answers when you are asked why you want the presidency: America, freedom and freedom. Every once in a while, Procter & Gamble, and other consumer staples, get their moment in the sun. This was in April and February of last year when an unknown virus infiltrated American society. Consumers rushed to their local supermarkets and big box retailers, and purchased everything related to consumer goods, including toilet paper. Full disclosure: I found Procter's Charmin Ultra Strong Mega Rolls to be excellent value for money. I won't go into detail about the former. Will PG remain a stable dividend stock? Yes. The yield is not something to be excited about, but the core business specializes. This demand stream is unaffected by recessions. Number 5. Safe dividend stocks is Coca-Cola, called CO. Coca-Cola is not a dividend stock to look at, especially if you're concerned about the future of the economy. Multiple reports have shown that millennials are gradually switching to zero-calorie soft drinks, and have eschewed sugary sodas. This is not a good thing when your corporate brand revolves around sugary drinks. Coca-Cola's management team is aware of this problem and have been working to fix it over the past few years. Coca-Cola's healthier options can be redeemed by offering younger customers thinner packaging and relevant designs. It's also not clear if millennials are as health conscious as they claim. If this were true, it wouldn't be difficult for the military to recruit people based upon health standards. Many soda brands are also making a comeback due to the nostalgia effect of older millennials. It's also important to remember that CO stock is one of the most reliable dividend stocks to purchase during economic uncertainty. As a form of cheap indulgence, Coca-Cola branded products aren't worth cutting from the budget unless things get really desperate. Number 6. Abbvie, called Abbvie. Abbvie enjoyed a strong performance after the March doldrums, despite not playing a prominent role in the COVID-19 crisis. Yes, Abbvie stock took a temporary turn for the worse after the crisis hit. It has been relatively successful since then. Abbvie began to look intriguing around the fourth quarter 2020. Many analysts believe that the crisis will be significantly lessened by 2021. If that were to happen, regular healthcare requirements, regardless of whether they are acute or chronic and not connected to the pandemic, will take their place. For Abbvie, its Botox business that it acquired through the Allergan takeover should prove lucrative in the post-COVID environment. That's because for roughly 1 year, millions of Americans stayed home over concerns about coronavirus infections. People will care more about their appearance now that this negative catalyst has become less of a concern due to multiple factors. Cynically, this is a tailwind to Abbvie, making it an interesting investment among safe dividend stocks. Safe dividend stocks number 7 is Prudential Financial, called PRU. The idea of investing in insurance companies is often frowned upon by most people. Boring is a good quality if you are looking for super safe dividend stocks. Prudential Financial, an insurance company, offers a fascinating outlook, particularly after the coronavirus pandemic. Americans have been protected from terrible events in other parts of the world for decades, especially developing countries. Yes, there have been many natural disasters and terrorist attacks. The coronavirus pandemic was undoubtedly the first major crisis in American history that required everyone to contribute their time for the benefit of the nation. Many people have been made aware of their mortality during this time of collective sacrifice. It is reasonable to expect that financial products like life insurance will increase. The pandemic has taught us that life is precious, and can be taken away from you at any time by invisible and visible threats. That's a huge wake-up call, one that cynically benefits Pru stock.
Thanks for watching. Please subscribe and press the bell icon to get a notification. Business Snap. Finance and investing updates.